Investors Chronicle.
Hello and a very warm welcome back to the IC Interviews podcast. I'm Dave Baxter, the funds editor on the Investors Chronicle, and today I'm joined by Jasmine Yeo, manager on the Ruffer Investment Trust. I should note that we are recording this on the 23rd of April. Clearly been a very busy time in markets, and there could well be fresh developments in the world of tariffs or in markets between now and the publication of this podcast. So Jasmine, thanks for joining. How are you getting on?
Yeah, thank you for having me. It's been pretty extraordinary. In the space of a week, we had both the kind of fifth largest fall in 2 days for US equities, and then a few days later, the seventh best day of all time. So, it's pretty important to stay awake and well fueled at moments like this. But it's interesting. It's interesting.
Yes, yeah, sounds like a slightly euphemistic word, interesting at the minute, doesn't it? But it's quite fascinating. As you allude to, it's clearly been an extremely volatile few weeks in markets. April has been pretty crazy. Ruffer kind of seeks to, I suppose, get people through these points of turbulence and provide a bit more protection than some funds might. So, just to kick off, how has the portfolio held up in April? Have the components kind of done what you hoped for? And I suppose, sometimes things behave in a way that you don't expect. I wondered if you kind of seen that in any parts of the portfolio as well.
Yep. So the headline is that the protections that the trust owns and that we would look to exactly at times like this, as you describe, have very much been behaving as we expect and as markets have sold off. And that's meant that we've been able to sort of build on the gains that we've made earlier on in the year when equity markets were sort of rotating in a perhaps more benign fashion. And that's left the portfolio and the trust up sort of roughly mid-single digits year to date, and a small positive return since markets have started to fall kind of from mid-February. Clearly very early days in this process. Our kind of base case is very much that there's a lot more to play out here, but it has been good to have been able to preserve capital and grown capital so far, which leaves us in a kind of good position to continue to do so, and also to take advantage of the opportunities that this kind of disruption throws up. And as you describe, it's really what we would expect to have been able to do for investors. It's a trust focused first and foremost on capital preservation. We are aiming to be that port in a storm at times like this. Really, we'd like this holding to be sort of the last thing that investors might worry about in their portfolios when sort of markets are experiencing stress. I think interesting to think about what's driven that performance, so how we've achieved that capital preservation and growth through a tricky period. And it's really been down to the potency of our derivative protections that we hold. So things like equity downside protection, credit protection, which we own good amounts of going into Tariff Day, Liberation Day, given our views that we held sort of towards the end of last year that this new administration was very likely to bring a loss of volatility to what was a very richly valued US equity market, and with lots of investors sort of very fully positioned in US equities and credit. And therefore, what you've seen as corporate borrowing costs have risen, as equity market volatility has risen, those protections have contributed very positively to performance. They've managed to offset losses that we've experienced in our equities. And then we've had our sort of precious metals exposures and Japanese yen exposure sort of adding positively to performance on top of that. What have we been doing, or what have we been up to since then? Trying to very actively manage the profits across those protective positions. So we have taken profits in several of the shorter dated sources of protection. So things like that volatility and equity index protection, but at the same time remaining very cognizant of the fact that we need to maintain sufficient protection if conditions start to deteriorate again. What we haven't done is sort of aggressively re-risk portfolios. I think it's probably too early for that. But we've also not meaningfully sold down our risk assets. Helpful at the starting point in the portfolio was pretty defensive, but we have held on to our sort of about a quarter of the portfolio that we do have in equities that should be there to benefit if we do get a return, even if it's temporary, to kind of a more bullish or positive scenario. But clearly keeping an eye on how things develop. But having preserved capital thus far puts us in a nice position to take portfolio action as and when opportunities may arise.
And this is, yeah, obviously, I suppose, subject to conditions and a very tricky question to answer. But what would you look for to kind of make you decide that it might be a bit more sensible to start adding risk and start kind of moving into equities? Because I suppose it's been interesting. Things have obviously fallen quite a lot, but at least when it comes to professional investors, a lot of them have still been quite kind of wary about going in for the time being.
Yeah, I mean, so obviously there's lots of things to watch out for at the moment. Obviously, the kind of hard growth data is a key one, very important. Whether that's corporate profits, employment data, which have all held up pretty well so far. But thus far, you've only sort of seen a turn in the soft data, sort of expectations and the like. But beyond that, there's a lot of uncertainty, and that's a major challenge. Clearly, any sort of deliberate action from the administration to give more clarity, provide more uncertainty would be a positive. There's been a bit of noise around that in the last couple of days. But even so, I think that's pretty difficult given the kind of multiple objectives that they've got over different timescales. They may want to give more clarity on things like tax changes and deregulation, but that's probably a little bit further down the line. Tariffs are kind of also clearly the immediate impact. Other things we look at or kind of focused on at the moment, clearly the bond market, central bank liquidity, funding conditions, all really important things. And also the extent to which, I guess, asset allocators, to your point, are adjusting or not their longer term positions. And that kind of speaks to our, I guess, concern that actually the damage is largely now done. It's going to be pretty hard to put the genie back in the bottle now in terms of uncertainty and this sort of shift away from a narrative which has been incredibly powerful over the last few years around US exceptionalism.
Mm. I noted, especially at the start of this year, people started developing this narrative of US exceptionalism and everything going to be great under Trump and so on. And now opinions have turned pretty sharply. Are you guys also kind of positioning for an end of US exceptionalism and a time to be, not just equities, but also in terms of currencies, bonds as well, kind of positioning away from the US and looking at other regions? Or is it too early to tell, or do you kind of disagree with that?
A key thing to point out at the start maybe is that our strategy and the way we build the portfolios will always be positioned for a range of different scenarios. We are looking to try and deliver that all-weather return. And what I mean by that is just achieve the objective of capital preservation and steady growth, regardless really of whether markets are rising or falling. So there's a number of kind of different positions in the portfolio. I do think, though, sort of the key risk longer term is around this shift away from the US and US assets, where sort of investors have been very overweight the US and rightly so for a long period of time. That really was our core thesis coming into 2025, so kind of ahead of this tariff turmoil. And it remains that the US exceptionalism we think is unlikely to be sustained. It's something like my colleague and our co-CIO, Neil McLeish, wrote about very eloquently in our recent publication in the Ruffer Review. And so I'd urge anyone to read that if they want a bit more detail and kind of clear explanation. But it's the fact that US assets have been by a long mile, the number one beneficiary of kind of global capital flows for decades, really, and for good reasons in many cases, whether that's been around tech leadership or even sort of more recently, the huge fiscal expansion we had post-COVID. But today we've got a very different starting point. In some cases, those advantages have perhaps eroded. DeepSeek announcement earlier in the year being a kind of clear example of that. And there's now a lot less policy room. Hence, you've got these fundamental questions now being asked about the role of the dollar around US assets. And I do think that sustained period of US outperformance looks pretty unlikely to return. And the arrival of this administration very much kind of reinforced that thesis rather than diluted it. And then in terms of how that's reflected in our positioning, we've not held a large allocation to US equities. That's been a small proportion of our equity allocation. We have had significant exposure to rest of world, namely UK, Europe, and China.
Yeah, I mean, are there any regions, now looking especially promising? I don't know whether you look at that on sort of evaluations basis or more of kind of a narrative. What is kind of standing out as we potentially turn away from the US?
Yeah, so I think, look, it's clearly possible that even if briefly, we do kind of return to a US-centric equity market rally, and therefore I think it's important that we don't dismiss that entirely. You could well get some pretty strong recoveries, and particularly if you do get more headlines and kind of further policy U-turns. And a portion of our equity book is exposed to the US, and perhaps a theme I'd highlight there is US banks. So some of the larger names, we think they're well run. Valuations are pretty reasonable. Some of them are doing buyback programs. And clearly, kind of over the medium term, they're going to be beneficiaries of this administration's aim to provide some capital and regulatory relief. But perhaps I think we more likely, or what I'm more exposed to if we do return to an equity bull market, is that that's going to be centered around ex-US markets, particularly if we are able to avoid sort of recession and you do get China and Europe doing more self-help and sort of fiscal stimulus. So that's why sort of half our equity exposure is exposed to Europe and the UK. We've retained a pretty meaningful allocation to China, where the
Mm.
exposure there is a mixture of sort of broad domestic exposure, and we've also got some stock-specific exposures to kind of tech and AI themes. And I think that really kind of speaks to this longer-term view that ties into the discussion on US exceptionalism. And I think it's very much front of mind that allocators are having to now consider their extreme concentrations to US assets, and that capital has therefore got to go somewhere.
Yeah, yeah. It'll be interesting to see what starts to dominate if we do see the end of the US exceptionalism narrative play out a bit more. I wanted to turn to some other asset classes. Obviously, you make quite a large use of bonds. If you look at the end of January, you have nearly a third of the fund in sort of short-dated nominal bonds, and then you have some smaller allocations to kind of inflation-linked. Um, is that still kind of a mixture that you're happy with? Would anything tempt you, for example, to go into kind of longer dated bonds? I suppose in theory they should benefit if you saw more of a kind of risk off mood setting in again.
Yep. So I kind of think of the portfolio as having three buckets of bonds, if you like. You touched on two of them. The first one being that very significant allocation to short-dated US and UK government bonds, which are pretty much cash-like, providing us an income, but more importantly, that kind of firepower to take advantage of market stress. We then got the inflation-linked bonds that you referenced, and that's really part of the basket that we hold of assets there to protect against our structural view that we are likely, or we are now in most probably, a world of higher average and more volatile inflation. But as you reference, those bonds, that they're very long dated and therefore carry a decent amount of duration. We would expect those assets to help in a recessionary environment.
Mm.
And that is where kind of all of the bond duration in the portfolio comes from. And the third kind of bucket of bonds, if you like, are very short dated JGBs, so Japanese government bonds, which give us exposure to the yen, which we like both as actually a sort of a cheaper form of duration. I would expect the yen to appreciate if you get lower US interest rates, as that rate differential closes between the US and Japan. But also, we see the yen as a safe haven asset and one that's likely to appreciate if we do get more market stress. I think zooming out a little bit, our view on duration and the reason actually the portfolio's bond duration is pretty low relative to our history is we continue to think that fixed income is kind of a tricky place to be. If we do head towards recession, I think you're right in the sense that if the recession is sort of sufficiently mild, then you are going to get a fall in yields, perhaps without a need to provide a huge amount of fiscal support. But actually, typically, when you get a US recession, you see the deficits expand by sort of 3, 4, 5%. And given the starting point of the US deficit, that's going to probably cause a lot of concern and maybe put upward pressure on yields, in fact, in that environment. Similarly, if we don't get recession and you get a kind of a stronger US growth environment than perhaps is currently expected, then again, yields are likely to rise, particularly if inflation starts to come back again, given the starting point still being above target today. So, in many ways, the conversation we have internally is given those kind of two scenarios, why take the risk?
Mm.
Given particularly the additional point around concern on US exceptionalism and if treasuries remain a safe haven asset. And that's a structural risk, this point around bonds perhaps being a more unreliable protection relative to the last couple of years or decades even. That's something we've been flagging for some time. It's something I've written about. We do expect bonds to be an unreliable protection. It's going to force investors to look elsewhere for that diversification. And it's why we continue to use this derivative toolkit within the trust.
Yeah, I was going to say, what do you still view as more of a reliable protector? So you mentioned the yen, classic safe haven. I guess that, yeah, things like the options, perhaps gold as well. Yeah, what would kind of sit in that list?
Yeah, I think the fact that you just listed a number of things speaks to exactly the need that we now have, is that there's going to be a requirement to be more flexible and have as wide a toolkit as possible, I think, in this new regime, in this new kind of more volatile investment environment, in a world of sort of higher average and more volatile inflation. Different assets are going to work at different moments in time, and therefore investors can best prepare and protect themselves by having access to a real range of different assets. You talked about, we mentioned fixed income. At times it's going to be helpful, at other times it won't. Options and derivatives can be a very powerful protection, clearly more complex, and can be a source of frustration, given you have to pay up to own them, much like you would a sort of insurance premium. Gold, I think, definitely
Mm.
got a role to play, and I'm sure we can come back to that because there's lots of things to say. But perhaps the other thing I would point to is a wider basket of commodities. If we do find ourselves back into a world of rising inflation, as well as options, perhaps, as well as gold, a sort of more diversified basket of commodities, historically have been shown to be the best source of protection in a world of high and rising inflation. And that's something I would expect to perhaps see a bit more of in the portfolio if we are to find ourselves there in the medium term.
And yeah, let's turn back to gold. That's I think end of January. It's well, just shy of sort of 9% of the portfolio. What's your kind of feeling there at the minute? And also, it'd be interesting to touch on the kind of exposure you get, because if I'm right, I think you actually have exposure more to kind of gold related equities rather than the physical asset itself.
Yeah, that's right. So we've got about 9-10%, somewhere around that, in sort of what I would call high beta gold exposures, a collection of different precious metals exposures, a chunk of it in gold equities, so mining equity companies, and then also some silver and some platinum. The reason for kind of favouring those over bullion itself is a number of those, particularly gold equities, at sort of near lows, or at least multi-decade lows, relative to the actual gold price. So we think there's quite a lot of upside on offer there, to where the gold price is today, and particularly with the miners, for example, they're now delivering sort of record high margins and have started to act with leverage to the gold price, and they've also been benefiting from lower oil prices, which are clearly a very significant input cost for these companies. The silver is also a kind of geared play on gold. Platinum is held a little bit more for kind of its own idiosyncratic reasons. In terms of our view there, though, short term, clearly gold has been on an extraordinary run. From a valuation perspective, if there is one, it does look a bit stretched by a number of different metrics, kind of even on an inflation adjusted basis. It's near an all-time high. It's also something that people own generally or can do with a lot of leverage, and it's had a lot of momentum behind it. So I would say it's potentially vulnerable to kind of material declines from here if we do see things deteriorate, or even sort of more periods of panic. So we are alive to those risks, and as a result did sell or have sold a small amount of our gold equities. But we have held on to the bulk of it, and that's because I think from a long-term perspective, the structural drivers are very much intact. It's, we think, a hedge against policy uncertainty, especially around trade. It's a hedge against monetary instability, currency debasement, and clearly the kind of geopolitical fragmentation that we're witnessing. And I don't think any of those things are are going away anytime soon. If anything, they're more likely to get worse. And so gold plays a kind of nice role in the portfolio. The other thing is a lot of people, for all it's spoken about and discussed, it's an absent asset in a lot of institutional allocations. But if we are now in a world where there's a less trust in the US dollar, less trust in US treasuries, then I think it's quite likely that those allocators are going to want to own a bit more of it.
That's an interesting point. So you have more of a volume of money towards it.
Exactly.
And just sticking, I guess, with the, as you mentioned, there are loads of potential kind of diversifiers you can have in your toolkits. I suppose one set of assets that people used to view as diversifiers, but perhaps, I don't know, perhaps they're a bit less confident now, are things like infrastructure, maybe even property. I suppose some of those kind of non-gold real assets. And then you can go into all sorts of weird and wonderful alternative assets. We used to have music royalties and so on. Are there any of these that have kind of turned your head, or has it not really sort of, you know, met the standard required?
Yeah, I think it comes back to the discussion on fixed income. These are very interest rate sensitive assets, and as I think a lot of people learned the hard way in 2022, in many cases they are forms of duration in disguise. So, given the concern about inflation and perhaps more periods like 2022, when you do see these all conventional asset classes, including what you're describing are sometimes described as alternatives,
Mm.
we would suggest that there's a risk that they are correlated. When equities fall in the way that they were in 2022, and so we're a bit more cautious in that respect, and that's before we've even thought about liquidity.
Yes, yeah, yeah. Lots of reasons for caution. And you've already kind of mentioned some of these, but I suppose Rough is interesting because it is, one of the funds that does take perhaps more of a top-down view or a kind of broader view. What would you view as kind of the main, I suppose, macro threats and opportunities that you're now trying to position for? I'd imagine one would be kind of inflation, but yeah, what's kind of featuring there?
Yeah, so I think our outlook is we're not out of the woods yet. This clearly, what we've seen with reciprocal tariffs and just kind of the new administration's general approach to policy has caused a lot of disruption in terms of tariffs in particular. That's a massive supply shock for the US, big demand shock for the rest of the world. And I think despite any sort of U-turn on those policies and the various noises we've had since, we would expect a lot more volatility, and I would anticipate that markets continue to whipsaw, and it's very difficult to have any sort of high near-term conviction, at least in terms of the direction for markets. So I think it's important to zoom out a little bit when thinking about these risks and opportunities, acknowledging that the near term is very difficult and very uncertainty. And that where we do have some conviction, really comes back to the idea of they are wanting to drive fundamental change here, and it's now going to be very difficult to put the genie back in the bottle in terms of that uncertainty. I think it's very unlikely that we go back to that pre-liberation day world when there was much lower levels of policy uncertainty and volatility. And that means that I think investors should be compensated more for the risk that they take on. I would want to see risk premia rise, especially on US assets, given what are still above historical average valuations, and the fact that there's now a material chance of at least a slowdown, if not recession, in the US. But clearly, if we do see further falls in US assets, then that in itself creates the opportunity. So I think our focus is on putting ourselves in a position where we can preserve and grow investors' capital through this particularly uncertain and difficult and volatile period, to ensure that we then are on the front foot to kind of step into those opportunities as and when they arise. And that's really how we've approached portfolio construction and
Mm.
expressed our philosophy over the 30 years we've been doing it, owning the right assets in the tricky periods, but then being ready to redeploy when the opportunities present themselves.
Yeah, yeah. And on your kind of, I suppose, growth and equity exposure, one thing that interested me was just that, say you do, for example, have a MSCI China fund, but also you have some kind of direct equity holdings. So I was just interested to get your thoughts on like the mix there. Is it generally a case where you're still finding more value in kind of individual stocks, or I'd wonder if it was actually simpler just to kind of use, a regional equity tracker to get an exposure.
Yep. So that's largely been the case. You'll see that the kind of predominant or majority of that exposure is broad kind of onshore domestic equity exposure. That's been
Mm,
our kind of preferred way to express that, with a view that if you do get even more kind of stimulus from authorities, which could come in response to tariffs, if there kind of is a stalemate and there's no backing down, then it will be one area of the world where fiscal stimulus is being added, potentially alongside Europe. And if markets do kind of continue to follow the fiscal, then we expect potentially capital to flow there. As I say, the other kind of source of exposure there is through a couple of single names, which are really playing that kind of China tech AI theme, which has done well year to date, initially catalyzed by that kind of DeepSeek announcement, where there's some really interesting and exciting developments going on. But crucially, the valuations at which you can get access to that theme are very appealing in that region.
yeah, yeah, interesting. Well, plenty of food for thought there, but I'm afraid that is all we have time for. So I'd just like to thank you, Jasmine, for coming on, and thanks to everyone for listening. Take care.